Hi, my friends. I just did a video on why I'm still keen on the Wellington Fund. I want to elaborate that on a little bit and ask you what type of investor you are, because in my opinion, there are two types of investors. And this will be a lot of similarities to the video I just did, but I want to make sure that this gets it gets out there in the interwebs, because I think it's important. And you never know what videos people are going to come by. So there are two types of investors. Which one are you? All right, so let's start with point one. I am 50 years old. I still got kids in their teens. I still got a kid who's 12, preteen. All right, my oldest is 20. My youngest is 12. I'm 50. My wife is 47, 46, 47. Born in 1974, so she is 46. All right, so she's 4 years younger than me. I plan on working for at least another 10 years, at least. So that means I am a long-term investor, which means I'm still in accumulation mode. I am still adding to my portfolio on a bi-weekly basis. I'm accumulating. I'm an accumulator, all right? Now, what that means is I am willing, and this was what you have to make a determination for you as an investor, to go hell's bells and take all the risk I can in order to get all the upside I can. And that simply means I'm willing to take more risk in my investments, even though more risk means more downside potential. Yes, I get that. Downsides do not hurt me because I'm investing each and every 2 weeks. So if the market falls and I'm able to put money into it, I am getting more shares for a cheaper price, if that makes sense. And that's hugely beneficial to folks who are in accumulation mode. You're banging away, put money in, put money in, put money in. Believe it or not, you actually don't mind a market chaos. You don't mind a 2000, 2001, and 2, where you could just add to your portfolio on a regular basis, in which to buy as many shares as possible, because in 20 years, those shares are worth a hell of a lot more than they would have been if you bought in 1999. Think about it. If you buy 100 shares, if you have $100 and the market's trading at 100 in 1999, you buy one share. If the market falls 50% like it did until 2003, and you still have $100 you're putting in, you've now bought 2 shares, all right? 100 shares versus 2. We'll just say there's a $2 per share dividend. Well, the first example, you only get $2 because it's $2 per share. The second example, you get 4 because you have 2 shares. Compound that over quarterly dividends, year in, year out, year in, year out. On top of that, now we're going to say the market price is $200 20 years later, all right? So you had 1 share, and forget even the dividends for the time being, because I can't do that calculation in my head, but you have 1 share is worth $200 because you bought that share at the top of the market in 1999. You've doubled your money plus dividends. Still not too shabby. But the point is, when you bought in March of 2003, you had 2 shares, and they're each worth $200 now. So you have $400 as opposed to $200 because you bought when the market was getting killed. That is a sound of angels for an accumulator. A market decline is freaking perfect because you can buy more shares for the same amount of money. And shares are what determines wealth. Price per share is secondary. It's the shares, the amount of shares, which determine wealth. All right, so now that's an accumulator. I hope I was able to explain that well. We like market declines because we're putting a steady amount of money into the market. And when the market gets killed, we're putting that same amount of money in, which means we're buying more shares. And we'll have more shares reinvested, get more dividends reinvested. And for the long term, that's just freaking awesome. Now, and the second investor is a decumulator. Someone who is living or will need to be shortly living off their portfolio. All right, so that's not me. All right, I'm not living off my portfolio right now. I'm just throwing money in, throwing money in, throwing money in. In the accumulation stage, you are now living off that portfolio. You can't afford a 2000, 2001, 2002 decline because what everybody knows is sequence of return risk. In 2000, the S&P 500 was down 9%. In 2001, the S&P 500 was down 12%. And in 2002, the S&P 500 was down 22%. Ironically though, Wellington Fund, like I said on my previous video, was up in 2000, up in 2001, and it was down a little bit in 2002. And the reason for that was a couple things. The bonds gave a nice little buffer, and part two of that is that the value stocks that the Wellington Fund all their stocks are value stocks, did not take it on the chin at all until 2002. So that gave the investors in Wellington a significant reprieve, and for the decumulators, that meant they did not lose as much as they did in the S&P 500. So they did not have the same sequence of return risks that the S&P 500 investors, which meant their portfolio would certainly last longer as they're pulling money out of it than the investor in the S&P 500. And that's what you got to say. I said, man, I am in decumulation phase. Now, what people say is, but Josh, the S&P 500 smoked the Wellington since blah, blah, blah. When you're in the decumulation stage, the average annual return for any significant amount of time is irrelevant relative to the average safety of that return. It is return of principal, not return on principal. That matters when you're in decumulation stage. I want to make sure that if I have $100,000, it doesn't fall to $45,000 like it did in the S&P 500 after 3 years, especially if I'm pulling money out. Remember now, if you're taking 5% a year off $100,000, that's a 5% distribution yield or distribution rate. If the market falls to $50,000 and you're taking 5% a year off, that's a 10% distribution. There's no way you're going to survive a 10% distribution rate in that scenario. It's just not going to happen. So you're still taking the same $5,000 out, but $5,000 off a portfolio that has fallen 50% is a hell of a lot more than $5,000 off your initial amount, which is $100,000. And the second, you're not going to survive. Your portfolio will collapse for sure. This is what Dave Ramsey gets wrong too. When all these people calling, Dave, I got $1 million. How much can I take from my portfolio? And Dave says, well, if you go back to 1926, S&P 500, whatever he talks about, he doesn't say the S&P 500. Large cap stocks have averaged 10% a year, so you can take 8% a year off without running out of money. That's just foolhardy. That's foolish stuff, rookie stuff there. Shouldn't do that because you can't take 8% a year off thinking you're still going to add 2% a year to capital. That's nuts. That is the avoidance of the sequence of return risk, which is real for sure. And not to see that is frankly silly to me, and actually even worse. It's going to devastate people. Don't do that. So what happens here is when you're in decumulation mode, we are not saying this portfolio did better than that portfolio. I don't care on the upside. It is downside risk that we're trying to avoid. And again, downside risks, you got to be careful there because a lot of people will say, hey, you can avoid the downside market by all these high fee falutin stuff. No, don't do that. Downside risk is quite simple in terms of just making sure you have a diversified portfolio, you have some bond exposure to give you that, or at least cash exposure to give you that buffer when the markets fall, but you're not just all in a mutual fund or an ETF like the S&P 500, which is very, very heavy on momentum. Momentum is what drives the market on the up, and it also drives the market on the down. Again, revisit 2000, 2001, and 2. S&P 500 was up like crazy the latter part of the 90s. I remember this. It was averaging 30% a year from 95 to 2000. That was before even Greenspan talked about irrational exuberance, which was in 1994 or 95, I can't remember. After he said that, irrationally exuberant investors put the S&P 500 up to freaking 30% a year in the latter part of the decade. Kaboom! All those gains were given away in the first 3 years of the new century. If you were in the S&P 500, if you were not in the S&P 500, you didn't get killed nearly as much, which meant your portfolio survived. Hope this helps. Would love to hear your questions. Thanks now.